podcast where we clean up the confusion and reveal the hidden treasures beneath the surface of blockchain technologies. I'm Phil.
And I'm Josh. And we get together each month and teach each other about interesting projects that we found. Come, experience the journey with us while we learn how to wield the power of digital ownership of finance and entertainment. Now, anything said by Phil or myself should not be considered financial advice, legal advice, or life advice. Anything said is strictly our personal opinions and should not be interpreted to induce a specific product or action. This content is strictly for entertainment purposes only.
In today's episode, we will be discussing dividends with our friend Don, aka The Bare Basics.
Our main reason for this episode is to explore other investment strategies and to see how they could fit into one's portfolio.
We will also compare and contrast how some crypto tokens are similar to stocks that offer dividends.
We hope that you enjoy this episode and learn something new. Hi all, welcome to Sweeping the Floor. You got Phil here and Josh and Don. Don's our really good buddy, and we thought it would be a good idea to have him jump on the show and kind of talk about his investment strategies and why they're good and maybe why you should add them to your portfolio. And he's going to just tell us about everything dividends today. So Don, how are you doing today?
Oh, I'm doing fantastic. Happy to be here.
Good. Why don't you tell us a little bit about yourself?
Sure. My name's Don. Let's see here. I've been investing now since 2018, so that would be like, God, that seems crazy. 8 years ago. Started it basically right after I got out of, not kind of while I was in postgraduate school. I went to UC for undergrad, knew about investing, didn't really get into it because I had zero money. And I was a psychology major, so like, was I ever going to make money? Probably
what even is money? You know?
What even is money, bro? And then after undergrad, went to law school. Was like, oh, this is how I can make money. And then after law school, didn't make any money, not becoming a lawyer. I ended up kind of taking a step back, and kind of at the point just trying to find a decent job. I was working construction at the time, and once I found a decent job, I kind of thought, well, I'm not going to make the money I thought I was being a lawyer. So how do I kind of increase my net worth? And that's when I kind of stumbled upon stock investing.
Very cool.
Wonderful, good stuff.
Yeah, it was. I literally. Not to sound like rags to riches, because I'm still in the rag adjacent section, but I literally started my first investment into stocks was $20, and I'm like, let's see where it goes, and then just kind of kept adding to it and doing stuff and research and all sorts of stuff.
So there you go. It's everybody always says that you can start crypto with like $5. Same thing with the stocks, people. Same thing with the stocks.
But it's about starting. You have to start.
Mm-hmm.
That is literally the most important part.
So how do you justify to yourself? I don't know how frequently you invest
that's a great question. So before I had kids, I've always been very budget minded. So basically, when I had my job and I felt that my job was pretty steady, I'd been there for a few months, and I got benefits and started investing. I guess technically my first experience was with it wasn't with 401k, I guess. But either way, once I started to get comfortable with my budget and how much I was living on, I kind of was like, okay, let's take this $20 a month that we put in. Let's start actually putting some real, I don't want to say real money because that's a little subjective, but what money can I spare? And my thought process at the time was basically okay, at the time, I didn't know about what emergencies could happen, right? So I stuck with my budget, made sure I had that money covered. And then I usually had a windfall. My original philosophy for investing in the stock market was, okay, if I lost this money tomorrow, if everything burned to the ground, or if someone hacked my portfolio and took all my money, I could still live on the money I was making, the money I had in separate accounts, et cetera, et cetera. So a lot of my money in my initial investing days was overtime and bonuses. As you guys know, I used to do closing transactions for real estate. closings, and my employer at the time would offer me a $100 bonus for every closing I did after like 5 o'clock, which was considered after hours. So on some days,
pretty good.
I was doing close. Yeah, it was great. If I was a fast enough talker, which I can be, there were some nights where I would be doing closings till 10 o'clock, 11 o'clock at night, and I'd get an extra $500 or $600. I mean, it didn't happen all the time. I don't want to pretend that was the regular, but during COVID, like right when about a year or so after I started investing, I was doing closing transactions all the time. I mean, it was crazy. There was one when I eventually left that job, I kind of stayed on part-time just as a closer. And there was one day where, and it only happened once, but there was one day where I literally came in. They basically offered me a deal where they wouldn't pay me an hourly rate. They would just pay me per closing. And they had me do 10 closings in one day. So I made $1,000 in a day, which basically I said, okay, how much of that money do I need for this day to, go toward my budget? And I think I put like maybe half of it towards student loans and the other half in the stock market. I mean, that was where that was where a lot of my money came from. Before
That's awesome.
Yeah, that's great. So I feel like a lot of people, when they hear about stock trading, it gets really intimidating because they don't know exactly when to start. They don't know their time horizons. They don't know if they should be like day traders. They don't know if they should do dividends, all of those sorts of things. I am curious as to like how and why you picked the thing that you picked.
All right. That's a phenomenal question and a great story if you ask me, because honestly, the whole reason my investment strategy at first was literally just I was super into solar panels and green energy. So I was like, what companies do these? So I found like some like battery companies, some solar, like real estate companies, not real estate, but like what is a dividend? And that really started it all. I Googled what are dividends and then found out that they're money that a company gives you for holding a share or partial share or whatever share of a stock for a certain amount of time. And it's basically from the company's profits. And if you hold on to that stock for the requisite amount of time, you just get this money into your, into your pocket, really.
Yeah. So can you go in a little bit more of a detail as to how that works? So like, for instance, like for a token that I hold, you have to do votes. You have to have, we can get Phil into this later, but you have to stake it for a certain period of time and then you have to vote and be proactive in it. How do you get dividends from a stock and how does that work? The flow of it.
The cool thing about dividends is they're very passive, but the idea is timing. So there are 4 main dates that are really important when it comes to dividend investing. The first one is the declaration date. That is when the stock, whatever it is, declares that they are actually going to have a dividend for that month or that quarter or the semi-annually, what have you. And that is the date when they'll say, hey, we have decided.
Don, thank you for that excellent explanation of what dividends are. Phil, do you have anything in crypto that is similar to dividends?
Yes. So, as you mentioned before, staking. So, with staking, for those of you who don't know, and Don, I don't know where you're at on staking, but essentially what you're doing when you're staking to a network in crypto, you're validating that network. You're basically locking up some of your tokens to make sure that the protocol doesn't essentially go down, so that more and more of the transactions can still be recorded on the quote-unquote public ledger that's on a blockchain. So when you do that, you get rewarded for doing that because the network is like, okay, you're helping us stay alive. Here's some extra cash. And we call these staking rewards. And you get them pretty passively again, where you just say, hey, I'll lock up my crypto for a certain period. And you don't even have to, some of the chains, you don't even have to pick a certain period of time. Some of the chains, especially in the very beginning of crypto, they want you to specify, I'm going to lock it up for 3 months, 6 months, a year, 2 years. But nowadays you can stake Ethereum or stake Solana for as long as you want to stake it. And then it just takes a little bit of time for it to come back out, because those of us in crypto love our instant speeds, our instant validation. But with when you stake in crypto, you can wait a certain period of time and then press unstake. And then when you press unstake, you have to wait a little bit longer, and then you get your reward still. Still, no offense, still faster than stocks, but it is essentially the same there. And Josh, you know a lot about staking. If you want to add more onto that.
Yeah, I actually staked when Ethereum moved from proof of work to proof of stake. So I was into it during that time period, and it used to be like a month you had to lock it up before you could unlock it. So if you saw the price drop by like 60%, you were literally dying trying to get things to unstake so you could sell stuff. And it was like the worst thing ever. It also is helpful in making you hold through really rough periods, because by the time it actually unstakes, everything's back to the price that it was before. So you didn't sell at the very bottom and then buy back in at a higher price and lose your ass. But I do stake Jupiter tokens like I talked about earlier. So for their dynamic, it doesn't necessarily help a chain because they don't have a chain yet. They are working on it. But for that, it's like a DAO token. So you stake it and you get to participate in votes. And when you participate in votes, you end up getting staking rewards. So it ended up being has been like 30% or something around that for the last couple of years. It's going to drop off significantly. But Don, I don't know anything about stocks and dividends. Do you just literally have to hold the stock during that time period when they announce that stuff, or do you have to lock it up for a period of time, or what? Like, is there anything like that?
You just literally have to hold the dividend, and I kind of have to go back a little bit. The payment date is usually, and I screwed this up. The payment date is usually a month after the record date. It's not a couple days. The ex parte date and then the record date, those are usually like a day or two apart. So that's my bet on that. And I guess that is like, it's similar to your guys' thing where you have to own the stock at the record date. Like,
yeah.
If you own the stock, if the record date's the 15th, you own it the 14th, and then you sell it, you're not going to get the dividend. You have to own it on the record date, which is like the 15th or whatever.
Oh, so that's kind of like equivalent to the hold, for your crypto staking for a certain period. That's interesting.
But
that is interesting.
But once the stocks once the dividend's confirmed that you owned it at that time, then you can sell. There are people that do that. To me, and again, this is subjective. To me, worth timing the dividend like that is a little extreme. If you're going to try and buy and sell when the dividend comes in, I mean, in my opinion, you're kind of doing that for pennies. But I'm sure there's some rich SOBs out there that are like, yeah, I'll just hold this stock for 2-3 days, make a couple thousand easy, and then sell. And I'm sure there's guys that do that out there.
Sure.
Yeah.
But
yeah.
So I guess when you factor in the stock price itself going up and the dividend itself, do you think that they are more lucrative than just holding a regular stock?
Usually I do, mainly because just like normal stocks, dividend stocks kind of have that herd mentality where, like with a normal stock, the way it usually works is the company that the stock has does well, returns a profit, or has a good quarter, or some news comes out which is good for the stock, and the stock usually goes up. A celebrity on SNL says this stock's great, ha ha ha, stock goes up. Fun magic.
The memetics of
right.
money, right?
Now, dividend stocks do the exact same thing, but they have the added bonus of having a dividend. So, for example, if you let me think here, Coca-Cola raised their dividend a couple of years back, and it was like they raised it like 15%, which for dividends,
Whoa.
they raised it. Well, I want to make it something very clear. They raised the dividend 15%. So it was 40 cents, and usually they go up like 2 cents every year or so or whatever. Yeah. So instead of doing 2 cents, it went up like 4.5 cents, which again,
so
that's
pretty big. Yeah,
that's good.
Is that per stock that you own?
Sorry, what did you say, Phil?
Is that per stock that you own?
Yes, yeah. So if I own one share, it went from 40 to 44 cents. If I own two, it went from 80 cents to 88 cents, so on and so forth.
Sure.
So that was pretty cool. And then of course, when that happens, a lot of times, same kind of magic. People are like, oh shoot, Coca-Cola announced a raise in their dividends. So then people buy that dividend, hold on to it for the record date. A lot of times the stock increases. Now, obviously, that works in reverse as well. If a company announces that they're not, I shouldn't say announces. If they don't announce a dividend, but they usually do every quarter or every month or whatever, obviously people, dividend investors especially, could consider that a bad thing, sell the stock. Other things happen, the stock goes down. Or some dividend stocks could cut their dividend or cut it in half or something. Ford did that during COVID. They basically said that they wanted to take the profits during that tumultuous time and kind of put it back toward the company, make sure their employees were good, make sure their debt was in a good spot.
Sure.
And of course, people weren't buying cars as much because you weren't allowed to leave your house. So there's probably a bit of column A, column B on the morality of that choice, but it made the stock go down. I mean, when I was into Ford at that time, and my stock went from like $15 a share down to like $6 or $7 a share, maybe even less. Now, of course, at the time, I was still pretty new into investing. Didn't have a whole lot of money into it, but I thought to myself, well, Ford's been around for 100 years. They've seen plenty of other pretty bad financial times. I'm sure they'll recover from this. So I actually threw as much money as I could into Ford, and even though they cut their dividend, and I did get rewarded, because that by the time that COVID was quote unquote, I don't want to say over, but basically a year later, Ford's stock price jumped back up to like $11, $12. But by that time, I had bought so much of it at a cheap price that I ended up making and again, this is very early in investing and not a lot of money when you look at money's subjective. I made like $700, and I really only put in maybe $2,000 total into it. So I only put like $1,300. I made got $2,000 when I sold everything. So I made $700. So for me at the time, that was really dang good money.
Now, is there a rule around when a company is going to change something around their dividends to when the actual change happens, letting the investors know?
So, that's a great question. So sometimes, yes, sometimes there will be like shareholder meetings that discuss dividends. Mm-hmm. They don't happen super often. And that's mainly because it really does depend on the company. When a company's been around for as long as like Ford or Coca-Cola, Johnson & Johnson, they've kept their dividend pretty much going consistently for the last 100 years. Ford, obviously, with that bit of exception during COVID, but they brought it back like a year or so after COVID happened. So there's really, I don't want to say no need, but they almost don't really talk about that, the shareholder meetings. And now if it goes up, I'll admit, I don't really know if they announced that at shareholder meetings. I'll be honest, I haven't really sat in on a lot of them when they ask me to do a vote or proxy. But it's usually I don't know. They do announce that stuff. That's kind of part of the declaration date, right? That's when they'll say hey, Ford declared a dividend, and then of course the media comes in, and it's 2 cents less than it was last quarter, or it was this much, or it reflects Ford's fiscal year being good. It's so yeah, that's kind of the coverage you get from it, I would say.
Gotcha. And since you brought it up, I did want to, address the voting aspect of dividends, because I know the first time I started investing in dividends, and then I got this huge packet in the mail about this. I was like, you want me to make what decision on what? I don't know. So let's walk people through that, because they're going to receive that in the mail.
All right, dude. Yeah, the voting stuff is crazy, because you're I see the download digital copy, and I'm like, okay, 30 pages. Yeah, that's sweet. Okay.
I don't know what you guys.
I'm important.
What am I supposed to do with my vote? Yeah.
I hold 10 shares of this company. How many are out there? 120,000.
Don or Phil, can you guys explain what a proxy is? Because
So at least the way I understand it, when I was reading through it, and when I first, like I said, got that packet, and I was like, I don't know what to do. It's you're essentially allowing somebody else to vote on your behalf, because you don't feel like you have enough knowledge about the company to make a decision. So that's a proxy vote, and that's what I do 100% of the time. I just take care of it, and if you drop my stock, then I will be leaving your company.
Just make me money. That's what I want.
I don't care.
That's fair. Don, what is your process in picking a company that has a good dividend? What are the things that you look into for that?
So everyone's a little different, and it really depends on your risk tolerance, just like with normal stock investing. Basically, in my opinion, you want a dividend stock that's going to be consistent, continue to pay, and you can rely on it. And you do want the dividend to consistently rise. there are a lot of stocks out there that offer dividends, and they'll be like super huge, but you really have to look at whether or not the dividend is sustainable. And what I mean by that is you kind of want to see, okay, how long have they been paying this dividend? And what's like the percentage of the dividend versus like the annual or the normal stock price. For example, you know, Ford, I know I keep coming back to Ford and like Coca-Cola. They've been around for 150 years.
This is now sponsored by Ford.
Right now. Well, hey, that'd be great. Hey, I drive a Maverick, baby. Let's go. Where's my Coca-Cola fridge? But I mean, seriously, they've been around for 150 years, so they've paid dividends forever. I got a Coca-Cola blanket.
Yeah, buddy.
Are we
yes,
dude now?
I mean, Coca-Cola does a lot of fun stuff in crypto land too, which is really cool.
Right, and that's the thing, right? So at first I looked at companies that kind of have their hands in a little bit of everything, companies that have been around forever.
Sure.
In the dividend land, we call that a dividend aristocrat, which is usually a dividend or a company that's paid a dividend for 25 years or more consistently. A king is 50 years, and I think an emperor is like 100 years or 75 years or something. I'll admit, there's not a lot of companies title. It's a little conceited, but it's fine. So that's what I look at. I look at companies that have paid a stock for a long time, and because I can also look at the history, right? I can look back at how Johnson & Johnson handled the financial crisis of 1987 and the Great Depression and freaking World War I and II. Even like more modern history, the recession of 2008, like you can really see what these companies did and see what happened like with their dividends. Did they cut it? Did they keep it going? Did they increase it? So it gives you like a good line of sight into what you think your dividend is going to be. Now, there's other dividends that are, like I said, if they're unsustainable, that's a little subjective, but it can be less subjective if you look at the history. If you see that, and there's plenty of stocks I've looked at where, they paid for maybe a year or two consistent, and then like 2 years ago or during the Great Recession, they stopped, and then or they only paid one dividend one quarter of this year, and then they did 2 quarters this year, and they're different values. And don't get me wrong, there could be some merit in going into that stock if you believe in it and think, okay, it's paying the dividend for the last couple of years. Maybe it's good. Maybe it's gotten really stable into its market now. But there's also stocks, in my opinion, that pay a little too little of a dividend. Some of the tech sector stocks are a good example of this. Microsoft and Apple both pay a dividend because they've been around for 40, 50 years now. But I think the dividend percentage compared to the actual stock price, I think is something along the lines of like 0.5% or something like that. It's you're getting like, I want to say, I don't know if either of you guys own Apple. Last time I had them, or last time I checked them, what are they at now, Phil? Like per share?
Doing live. Apple stock price as of today, February 20th at 9:44 p.m. They are at $264.
Okay, so you're probably going to see like a $1 dividend every quarter for that or something. Which, don't get me wrong, like that's fine. There's nothing wrong with free money, especially if you're into the tech stock for just the raising price of the stock. It's nice to get a little bonus dividend. But again, it just depends on your risk tolerance and what you want to do. I personally like to keep a stock that's got a dividend of like 5 to 7%. I think that's beats inflation a little bit, and also helps to increase it's good enough that where the stock sees some upward trend because of that dividend.
So tell us why. Oh, sorry, go ahead, Josh.
No, you're about to ask what I think I was about to ask, so you go ahead.
Well, my question was, tell us why a company would rather pay a dividend than to help its stock price go up.
That's a good question.
Yeah. So I think it depends a lot on what the company thinks they're giving back to their shareholder, right? When it comes to a dividend, you're pretty much, and this is why tech companies don't do it, right? Because tech companies want to reinvest all their money back into the company. They want to be on the cutting edge of what's happening next. With a lot of other companies that pay dividends, and which is why you don't see them in tech a lot. It's a lot of other companies that utility companies are a great example of this. They've provided the same service forever. They just basically want to reward shareholders for still believing in the stock and, giving them a little piece of the action. And for a shareholder, that feels fantastic because you feel like you actually, in my opinion, you kind of feel like an actual shareholder of the company. You're like, oh, I'm actually getting some of these profits back. And a lot of companies have a pretty good incentive into doing that. And it kind of leads to in my opinion, the double dip of dividends. is if you get a stock that's pretty consistent, like it's been paying for 25, 50, 30 years, whatever, you know that the company's got a pretty good incentive to keep that dividend going because that's what shareholders have come to expect of it over that decade or so. So you kind of feel a little secure because you think, okay, if they lose the dividend, then people are going to sell and the stock price is going to go down. And obviously the shareholders in mass and the company itself don't want that to happen. Now, I will say sometimes a company will have a justified reason for cutting their dividend or making it lower. For example, 3M, they cut their dividend in half. It was like $1.30 a share per quarter. It went down to 70 cents. And they did that. And they made sure everybody know that could have been at a shareholder meeting. I don't recall, but I knew it was like it came as like a little notification on my screen. And it basically said that the reason they're doing that was to help pay off debt and have too much debt. And apparently the shareholders loved that because that stock price went from like, I don't know, like $80 a share to like $150 a share within a couple of months. It was crazy. And then for me, it worked out great because I thought, well, the dividend got cut anyway. I kind of was looking for other stocks anyway. So I sold at a pretty good profit and really didn't have to look back at the dividend because I felt at that point it was a little not worth it for that much for that high of a stock price.
So, Don, why would somebody invest in a stock that issues dividends? Is there a benefit or anything that you think goes along with it aside from receiving the money?
Something I like a lot is a DRIP, which is used for dividends. It's a dividend reinvestment plan. Yeah. Basically, what this is that you can set it to be automatic, or you can do it yourself. I like to do automatic because it's automatic. I don't have to think about it. It's set it, forget it. And basically what this means is you are taking the money that the dividend pays out to you on the payment date, and it's automatically buying you fractional shares of the company. And what this does is over time, it compounds just like interest and allows you to buy more shares of the company, which gets you a higher dividend, which buys you more shares of the company, so on and so forth. My plan, and I think most people, dividend investors' plan, is to just keep doing that, keep letting that compound and snowball until hopefully retirement, when I can use it to either supplement my income or who knows, maybe even live off of it as Social Security becomes like a voucher for a sandwich every week or something like that by the time I retire.
I'm actually glad that you said that about the retirement part because I was like, why does it matter as much while you're working? But I guess whenever you're at retirement age, you don't have to sell the stock. You can just receive an income each month. So talking about that, what are the tax implications for receiving these dividends?
Oh, that's fantastic. So with dividends, there's kind of like three main areas of taxation when it comes to dividends. Mm-hmm. Dividends are considered regular income. So, when tax season comes around, you will get a 1099 from whatever your brokerage account is, whether that be Robinhood or Stash or what have you. And it'll basically take you through the different types of dividends you had. Mm-hmm. Now, when I say different types, I really mean two different types. There's ordinary dividends, which are taxed like normal income. And then there are what's called qualified dividends. Qualified dividends are kind of a weird animal when it comes to the dividend world because they could mean one of like three different things. An ordinary dividend is taxed at your tax bracket. So if you made, under what is it, like $12,000 in the year, it's like 12% or something, 24,000, not getting into that. You look at your tax bracket and you'll see how much your dividends will get taxed. Mm-hmm. If you have a qualified dividend, which could be, I'll get into qualified. There's two different types of qualified dividends. There's the dividends of stocks you've held for over a year. When you've held a stock for over a year and you're continuously getting the dividends from it, you'll sometimes get a qualified dividend, which just means it's like a cheaper percentage. Similar to capital gains tax, it'll be a lot of times at a certain flat rate, 15, 16%.
That's really cool. I didn't know that.
It's very cool. And then the other type of qualified dividend, and this one will really get you, is when you don't pay taxes at all.
Preferred.
Yes. Now here's the problem. Is I still haven't figured out. I need to ask someone. I really need to find someone who is a real expert on dividends. I have not figured out yet how to tell those dividends apart, because when I get my tax form, I look at the taxes and I look at the qualified dividends, and it's what I think happens is it divides them into when I got the stocks. So when my DRIP comes in, I'm getting ordinary dividend taxes on the drip ones because I haven't had them for a year. The ones I've had for over a year, I think I get the preferred dividend tax rate. And then there's just certain stocks, like I think Ford is one that has technically a qualified dividend. So I pay no taxes on those dividends.
Wow.
Again, it's complicated. That one I'm still trying to figure out because unfortunately you can't just plug into Google which stocks have qualified dividends because there's technically a couple different meanings of qualified dividends. So you kind of have to like really get into the company's financial sheet and your own stock portfolio to really see which stocks you're getting that advantage. But qualified dividends kind of mean a couple different things. The good news is if you see qualified on there, it's usually a good thing. It's an advantage.
Yeah. Phil?
Yes.
How are your staking rewards treated?
And for taxes?
Mm-hmm.
Okay. So for taxes, honestly, I might need you to weigh in here because I have a tax guy and I just give all that money.
Yeah, well, that's fair.
That's fair. Give me back my money that I'm paying.
I was like, I can't do this.
That's the way to do it, honestly. So my understanding is they're basically treated the same way. So it's treated as ordinary income. Same as Don was talking about, whatever tax bracket you're in, that's what it's going to be treated as. I used to be in love with the idea of staking rewards. And I understand why now that dividends are usually only issued by companies that have been around for over 100 years or longer, or have been around, have a lot of sticking power. Crypto is very volatile, as everybody knows. So when you get a staking reward, it's great. But like when it's during a bull market, that staking reward could be $1 for each like token that you're given. And then by the time it's tax season, and if you haven't sold, that $1 could now be worth 20 cents. So now you have a tax bill and you owe more than what you received in your airdrop. So that's the only drawback that I have in regards to like staking rewards and stuff. And that's the only because I've just been around for a long time. And I really like, you love the idea of, hey, I have this token. I want to own more of this token. And ideally in your head, that means more money, but it doesn't necessarily mean that with how volatile the asset is. Now that price might jump back up again in a year or two, but still you have to pay that tax bill. So you're either going to have to borrow if it's a really big tax bill and pay it and hope that it does go back so you can break even. You have to sell at a loss, which kind of sucks because if it's a long-term capital gain, it's not like you can carry that over to the next year. If you didn't have a bunch of gains that year, you can only carry over like $3,000 a year, I think, or something like that. So I'm a little jaded with it, with how things have been the last couple of years.
Maybe I'm going to be unstaking some things.
Well, again, and that's with the more volatile assets. It's not like, I don't think Ethereum's going to go from $4,000 down to $800 or something like that. But
I think I have like Cardano, XRP, all that kind of stuff staked still. Like it's just sitting there. Every once in a while it gives me a reward and I'm like, oh, cool.
Yeah.
I don't know.
I mean,
cool.
I don't have enough of it.
I do think the novelty of that idea is going to, and again, I kind of what Phil asked this question, why would a company issue a dividend instead of reinvesting that money and making the stock itself go up, especially in regards to crypto tokens? Because I feel like maybe not all, but most layer one tokens. And what that means is it's like an Ethereum, a Bitcoin, Solana. Those are all considered layer ones because they're an actual chain.
To our big 3 episode.
Yeah. Okay. So they're all chains that you can actually interact on. It's like the internet. Like the internet could be considered like a layer one. I get onto the internet, I build a website, I do all this stuff. So these layer ones are similar to that, but they're all financialized. Those have the ability to gain money based off of revenue fees. So whenever you do a transaction on there, you pay a fee in that token, and that's what makes that token valuable. The more people that use that, like that token or that chain or that system, the more valuable that token becomes. All the other tokens that are built on because of the burn, all the other tokens that are built on top of that. So let's think of like Aave. Aave is like a bank. So it's like a lending platform where you could go on and stake or use your crypto as collateral to borrow USDC to do something like buy a house or whatever. Or like Uniswap or Jupiter. These are like exchanges where I go on, I have a USDC token. I want to exchange that for Ethereum or Bonk or Doge or whatever. Like, and those guys gain fees based off of the transactions and things like that. The token itself is completely different. So like there's a protocol which is gaining the revenue, and there's developers that work on that who have control of that, and it's a company, right? But the tokens themselves are kind of like facades. They're kind of like, they don't have any ownership like an actual stock is. So that's kind of like the big meta right now in crypto is, do you own anything with this token? So like these staking rewards from these non-layer one tokens, they're getting a lot of like backlash. It's like, well, like, yeah, there's this DAO vote, but me as a token holder, I didn't get to present anything. You as the team presented the vote. So like, yeah, obviously you guys can skew this vote and make it look like I have a choice, but it actually, like, for you, it doesn't matter each way. It's either A or B, and A or B, you guys are fine with it because you have total control over it. And us as token holders, we just kind of have this voting mechanism. And I think the staking rewards kind of like, you get more of this useless token by staking it and trying to vote on these things. So
I mean, I think it's, fair to say it's similar to the whole proxy dividend. Anyways.
Yeah. I mean, you have to remember, like, again, with dividends, one of the positives, one of the pros, I guess you want to say, is a lot of people like dividends because if a company's paying a reliable, sustainable dividend, that usually is a sign of like financial strength in the market,
stability, and
right.
It's got staying power.
Yeah. And I think, and that's huge. Like that mentality, that psychology behind it, any sort of investment, any asset, really. I mean, think about it. You can equate that to like gold and silver, right? Why are people still buying gold and silver? We don't make any currency out of that anymore. I mean, yeah, I know they're
the greatest memes of all time. That's why.
Right. But what I'm saying is like those still have staying power because like they're still useful. There's still people that believe in those as like a good metric of wealth. So I think Bitcoin is just the newest thing on the game. Or I don't want to say Bitcoin, sorry. Cryptocurrencies are just kind of the newest like game on the block for that.
I actually disagree with that right now. Actually, I used to agree with that, but my philosophy on this has changed pretty significantly because you don't get dollars back for holding these tokens and doing these things. You get the token. And
I see. So you guys almost
different.
automatically put into a drip. Like you're getting automatically more.
It is.
Crypto.
Yes. It is automatic. So I actually think that like it's really interesting that you bring this up because it's cool that they actually give you dollars from the company. They're not making you buy the stock itself. You yourself are going out on the open market and repurchasing that.
I didn't realize you were just getting more tokens.
And it's kind of like these tokens, it's as if like if it was a stock, it's like, hey, we're just going to make more stock and just give you more stock. Joke's on you because like the value is going to stay the same and you're not actually really getting anything. We're just diluting the percentage of the stock out. So I see. I've kind of become a little bit more cynical on like staking rewards, unless it's a layer one. Layer one, obviously, like I like Ethereum. I love Ethereum because they have that burn mechanism, and also like it's good to do that. To be like Phil said, you are actually supporting the network by doing that. But and the tax consequences too. I mean, like had I got
a loon,
because had I gotten like USDC. I probably would have just pushed some of that back. Like, okay, I'm going to hold back like 20 to 25% of this to pay my tax bill whenever it becomes due instead of, well, it's a 30 to 40 day unstaking period. I'm just going to let it ride and see what happens type of thing. And now it's like,
so that's really interesting to me. So the reason, I mean, I guess it's not the only reason, but the reason I'm getting taxed is because I'm technically getting money back as income. Since you guys are getting the token, that's still taxed.
It is considered income based off of the IRS. There was a case where they actually tried to take the position of, hey, this is actually not money. You should treat this more like you should treat me like I'm a farmer.
Like a property.
Like they were like, treat me like a farmer. Like I put this seed in the ground. I grew this crop. There's corn now. I have this corn in my possession, but I don't have money from it until I take it to the market and sell it.
Yeah.
So that was the argument that they try to present. I think that the case got resolved for other reasons, so it didn't become case law or get brought up to the Supreme Court or anything. But honest to God, like I think that's the best way to treat it after experiencing all the stuff that I've gone through. Like you shouldn't get taxed on it until you sell it. Like
I agree.
Because it could literally go to zero.
Literally just getting this. You're literally getting the same thing.
Like, why does the government
care?
Why do I have to pay the government on an investment that I made that I might not even make any money on? And now I'm forced to sell it at a loss because the market's in a bad condition during the tax period. So it's really interesting
because it's only just
that's all.
Taxation without representation is theft. Yes, taxation without representation is theft.
That tea in the water. Okay, tea in the water.
So I'm sorry to get off on a rant, but that's just I think this I've been arguing. Like
it is. I'll be honest with you. I'm blown away by that. When you guys were explaining staking at first, I was like, yeah, this sounds a lot like dividends, a little bit more strict on like the holding of it.
Yeah.
But the fact that you are not getting dollars and getting taxed on it, and with that volatility
value of the worth,
that's crazy. I mean, because Josh, like you said, I mean, my God, that would. I mean, sorry, I'm not
trying to be a trader. Like I'm trying to be a long-term investor. And it's making it almost impossible to take that position. I almost have to unstake if I want to be a legitimate, like long-term investor, because this token that I bought. Go ahead.
So I was going to ask you a question about when we get our staking rewards, are they automatically restaked?
So it depends. I mean, I think a lot of stuff is automatically restaked. So like, for instance, like your Ethereum, I think this is actually a new thing that Ethereum added. I think, like, let's say, what was it? It used to be like 20 or 30 ETH that you had to stake, and now they have it to where you can stake like a partial amount and like group it up with other people. But like when you did that, let's say you did 20 ETH or something, okay, and then you get rewards for years. The rewards that you used to get were only based off that 20 that you had staked. You would have to unstake the other stuff and then restake it to be able to get that redrip. So that's what I was about to. Or what do they call it? Compounding interest on it. So now I think they have made upgrades and protocol changes to where it automatically restakes it for you. So it double dips. I think we might have lost.
Nobody asked.
No, we got him.
I don't know. Yeah, sorry. I was
no, we got him.
I just realized that is all my stuff just automatically restaking? That's.
I don't know, buddy. I don't know about the Cardano or XRP. I'm
not even worried about those tokens.
That's my knowledge on the on like ETH. I know Jupiter. If you get that, it automatically restakes it because it adds the number to your vote and everything. Yeah,
that's interesting. That almost sounds like a CD. Like have you guys ever let a certificate of deposit mature at the bank?
They send you a letter and say, if you don't withdraw it in like this 5-day range, you have it automatically restaked. So it's like, it seems super inconvenient to unstake it or take it out or whatever.
And I don't know if you know this, I don't know if you've let it happen, but like, let's say your CD was for like 4% or something. If you let it mature and get put into the certificate of deposit, it's not at 4% again. It's at like
whatever the new rate. Whatever the new rate is, yeah.
Well, a lot of times I've heard of them just like making it the federal minimum, which is like 1.2 or something like that. So you're really not getting nothing.
I think we're at a good end. So Don, thank you so much for coming on.
I really appreciate you, man.
Phil, it's always good to see you, buddy.
For me too. I do love the idea of crypto. I'll admit I just haven't had the knowledge to really get into it. But you guys really do know your stuff. It's actually insanely impressive.
Well, thank you.
Thank you, Don.
Yeah.
Yeah, and if we're gonna bet most of our net worth on this stuff, we got to figure it out.
Yeah,
Right?
I totally agree. You know,
Very-
and at least we're doing something, right? Like, again, we kind of talked
Yes.
about it earlier, like investing, as long as you believe in the investment, really, I mean, yeah, sure, there's obviously there can be downsides, but like it's better than having the money get eaten away by like inflation, right? And like and just sitting like where you're tempted to use it for stupid shit. Like,
Right.
you know, I mean, I can't tell you the amount of times like bonus time and tax season's right around the corner, right? So like I can't tell you the amount of people that are like, well, I'm gonna like buy a new car. And it's like, okay, you're gonna get like what, $4,000 on your taxes and get like a $40,000 depreciating asset. Like, sounds cool, good job, like fantastic. Like, you know, I don't know. It's just it's good. It's refreshing because there's a financial crisis everywhere. Whether you look at student loan debt, credit card debt, housing crisis, it's just good to know that like there's other ways to invest your money, and if you're smart with your money, the idea is it should pay dividends.
Hey.
Nice.
He brought it all back. Let's go.
Good job, guys.